don't worry about getting diverted or taking extra time. So we, in this particular segment, as in investing Carva, our first rule is that we don't stop our guests. So you are free to move as much as you like, because the more you will say, the more wisdom will be able to soak in. So, and anyways, the recording is the event is getting recorded. So if any one of us is having some commitment, they can leave whenever they want. But I'm sure most of us would want to hear you more. So don't worry about the time and getting diversion. So moving on now, as early investors, we all have our own role models and also a heavy dose of bias towards investing, right? So what were those early biases for you that you think you have overcome over the years in your investing journey? If you can explain with a few examples, that would help us understand it better.
So, I think first part of your question was about role models. Obviously, when I started in 2000, most of the literature, investing literature that was available was about Buffett and Lynch and primarily the value school of investing or the GARP school of investing. And that's how I also got started. It made a lot of intuitive sense, to buy into good businesses that can keep compounding. So that's how, that was the kind of investing style that I also started with. And a large part of it I still continue to do. Initial years, I think in India, I don't know if any one of you remember, especially people who've been around for a long time might remember that Ramesh Damani used to do a chat on Rediff. I think if I remember correctly, it was every Tuesday at I think 4 o'clock or something. He used to do a live chat, and for people like us who were, absolute novices, to be able to ask questions, even though it was a online chat forum, it was something like mind-boggling because there were very few, options to interact with, big name investors or people who, you looked up to. So I think a lot of learning from Ramesh ji at that point in time, early formative years. Uh, See, the biggest learning that you will get is about fixing your mindset, right? And I keep saying this all the time. Investing is 80%. It's If I look at the 80-20 principle, uh, successful investing is 80% about managing your mindset and your thought process and your psychology, right? You and I both can buy the same stock at the same price, uh, you know, and come out with completely different results, right? Because I may not be able to hold on, my conviction may be less, I may panic and sell out. Whereas, you may be able to hold on, through thick and thin, right? People like giving these stories, Amazon kya kitna acha ho gaya last 20 years, great thing. The problem is, if you look at the ups and downs of Amazon over the first, from 2000 to 2010, how many people would have stuck around? Right? Very, very difficult. Only in hindsight do you feel that you should have held on. I'll tell you my example. HDFC Bank, I bought with my second stock, if I remember correctly, that I bought in my life. Maybe 10 shares, right? Uh, I sold after it went up 20%. Right? I bought Pidilite, the first few share, few stocks that I invested in. The first stock I invested in was Hindustan Construction Company, HCC. Second, sorry, I made a mistake. Second stock was Hindustan Liver, HLL. It was not Unilever at that time, it was HLL. Then HDFC Bank, then Pidilite. So these were stocks that I bought in the year 2000. Now, when I look back and I think that, okay, if I had held on to Pidilite and HDFC Bank since then, even if it were minuscule number of shares and kept adding every few years or every 6 months, I would have probably had a much, much, much better outcome than what I did by trying to get 15-20% here and there. So the point I'm trying to make is that it is all about psychology, right? Identifying. So people put in 99% of their effort in trying to identify stocks. कि लेना क्या है बता दो, right? The point is, लेना क्या है is a very small part of the problem, right? Ultimately, you have to buy and you have to hold, you have to sit through pain, uh, because markets are non-linear, right? uh, it is not that you are going to get 8% returns every year. One year you will get 50%, next year you will get minus 20%. You have to uh, it's like Marilyn Monroe, right? I mean, I forget who said this about Marilyn Monroe. I think she said it about herself, that you don't deserve me at my best if you cannot have me at my worst. So the market is exactly like that. you know if you cannot sit through the bear market, you don't deserve a bull market, right? So coming again, I have digressed a lot and I've gone from where to where, I don't know. But coming back to your question, uh, I was lucky initially because I always had this problem, uh, that I always thought that I don't know enough because I don't have a CA degree, I'm not an MBA finance, or I don't come from a family where stock market investing is in vogue. I always thought that I did not know anything, so I read a lot, right? So I must have read over 2-3,000 books on investing over the last 20 years, maybe more, right? And I was lucky that initial few years I you know hopped onto some great books, uh, and I learned. I was lucky that I got exposure to behavioral finance very very early. So what I learned was that and I still see this problem with practically 99% of people. Our inability to sell at a loss or take a loss. Price anchoring. I'll sell when I get back my price. I bought it at 100, now it is 80. Let me wait. Let me see. It's so difficult to sell at 100. I mean, below my cost price. The stock doesn't know you bought it at 100. It doesn't care who you are, right? This is the most democratic setup in the world, right? Here, Rakesh Jhunjhunwala and you are no different. He might have more capital, you might have 1/10,000th of his capital, or maybe one lakh of his capital, but ultimately, when in terms of percentage returns, there's no difference between you and Warren Buffett. If you can identify a good stock, you can get a 10 bagger, and so on and so forth.